I'm Andrea Shalal with Reuters. We're here today to discuss some important and timely research done by the International Monetary Fund looking at the macroeconomics of conflicts and recovery and the impact of increased defense spending. This work analyzes data from 164 countries since 1946 and will be featured in the upcoming World Economic Outlook, which will be released in its entirety next week. While these two chapters do not touch on the war in the Middle East, which has now been underway for more than a month, the WEO itself will offer some initial thoughts on its impact on the global economy. In fact, the IMF last week released a blog which showed that despite the asymmetric impact of the conflict, all roads lead to higher inflation and slower growth. It is a sad fact that we live in a time of increased conflict and war after decades of relative calm following the end of the Cold War, with the number of active wars now at levels not seen since World War II. In 2024, before the Iran war erupted, more than 35 countries were experiencing conflict in their own territory. That same year, about 45% of the world's population lived in countries affected by conflict, ranging from localized border skirmishes to major wars. And since 2010 alone, more than 1.9 million people have died as a result of this violence, not to mention the millions turned into refugees. It is also a fact that wars are expensive. Estimates are ranging into the tens of billions for the first weeks of the Iran war alone, and that's just for munitions and operations, not counting the massive damages to infrastructure that we've already seen. Conflicts generate large losses in the countries where they play out, even bigger than those triggered by financial crises or natural disasters. And they can result in long-lasting scarring as well as spillovers to other countries. As you might expect, defense spending booms have also become more frequent, which may increase medium-term growth, but can also weaken a country's fiscal position and crowd out important social spending. To help take a deeper look at these issues, we are joined today in the studio by two esteemed IMF economists, Andresa Lagerborg and Hippolyte Balima, who helped compile this important research. We're also honored to welcome Moritz Schullerich, who is president of Germany's Kiel Institute for the World Economy and who regularly advises central bankers and finance officials. Hippolyte, you have been doing some work on the macroeconomic effects of conflicts beyond the horrific humanitarian toll. What are the key findings that you found in your work?
Well, first of all, thank you, Andrea, and thank you, Moritz, for joining us to discuss our recent analytical chapters. So now turning to the chapters, let me start with some kind of motivations behind both chapters. War, of course, have long been a feature of the global landscape. But as you just said, after a decade of relative calm that follows the end of the Cold Wars, the numbers of active wars globally have surged in recent years to levels not seen since World War II. And this is shown by the left-hand chart here. For instance, in 2024, more than 35 countries, as you mentioned, experienced conflicts on their own soil. And looking ahead, measures of geopolitical threat continue to increase, and that is pointing to heightened risk of conflict. And at the same time, growing security concerns are also prompting many governments around the world to spend more on defense. So in this context, Chapter 3 studies macroeconomic dynamics during wars and after war ends, and using a global sample since World War II. And we highlight three key findings. And the first one is that beyond, of course, the devastating human toll, including death, forced displacement, and also long-lasting adverse health outcomes, war impose large economic costs in countries where they occur. For instance, we find that output fall by about 3% at onset, continue falling in subsequent years to reach about 7% within 5 years. And these losses persist even after a decade. They leave lasting scars on economic potentials, and they also generate negative spillovers to neighboring countries and trade partners. So importantly, in our studies, we compare these output losses to those from other shocks, and we typically find that the output loss from wars exceed those associated with financial crises like banking, currency, or debt crisis, or even severe natural disaster. So the second key finding from the chapter is that war also impose large trade-off across fiscal, monetary, and external sectors. For instance, war-induced uncertainty generates usually capital outflows, forcing government to rely on aids and remittances for external financing. Wars also leave government with high debts and typically some strain on the external sectors. Government tend to respond by introducing, for instance, capital controls and also tightening monetary policy to contain the shock. But despite these measures, wars tend to be associated with sustained exchange rate depreciation, some reserve losses with sometimes subsequent import compressions, and also higher inflation. And this basically highlights how external sector dynamics can amplify wartime stress. The third key finding from the chapter is that most post-conflict episodes since World War II, peace is often fragile. For instance, in the data, we find that in about 40% of post-World War II, post-conflict cases, countries relapse into conflict within 5 years. And recoveries from post-conflict are also typically slow, uneven, and depend on the durability of peace. For instance, in cases where countries relapse into conflict, the recovery very frequently stall. In other cases where peace is sustained, output recover, but even there, it's remain low compared to wartime losses. And these slow recovery are typically driven by labor supply, while capital accumulation and productivity remain subdued. Now in the chapter, we focus on the role of policies to foster post-conflict recoveries, and I'm sure we may come back to that later in the conversation.
Yeah, we'll definitely want to look at the recommendations. Andressa, your work is focused more on the implications of defense spending, and we've seen, of course, some pretty incredible booms. And of course, we'll see more now with the NATO requirement and the pledges by countries in NATO to increase their spending to 5% of GDP. What were you surprised to learn when you looked deeply into those numbers and those trends over this long period of time?
Thank you, Andrea. Indeed, in Chapter 2 of the World Economic Outlook, we study over 200 episodes of large defense spending increases since World War II. We identify these episodes as periods when defense spending rises by at least 1 percentage point of GDP, averaged over 2 years and lasting for as long as this does not decline. We find that the frequency of these episodes has risen in recent years, particularly in emerging market and developing countries. And these episodes are also sizable. On average, fiscal or defense outlays rise by 2.7 percentage points of GDP over roughly 2.5 years. And this is broadly similar to the additional spending that NATO countries are expected to meet in order to reach their 5% of GDP requirement by 2035, as you just mentioned. And so we also look at how this is financed and find that the bulk of the increase in defense spending tends to be mostly financed by larger government deficits, as you can see in the chart in light blue. Although over time, governments also do tend to raise revenues to partly finance the higher spending, as you can see in gray in the chart. This is particularly the case when the rise in defense spending is perceived as more permanent. And of course, the large deficit financing also has implications for government debt, which tends to rise by roughly 7 percentage points of GDP over 3 years. Around 1/4 of all episodes are mainly financed by actually reprioritizing spending. In other words, reallocating spending within the budget envelope. And in these cases, we tend to see a sharp decline in government spending on social protection, on health, on education, and which points to clear fiscal policy trade-offs. Our findings also more broadly point to various other macroeconomic trade-offs that arise when ramping up defense spending. And this is perhaps clearly illustrated through our model simulations that are calibrated to the planned increase in defense spending in the European Union over the next few years, as shown here in the chart. And in this case, we can see clear trade-offs. So on the one hand, ramping up defense spending propagates through the economy as a positive demand-specific or a positive sector-specific demand shock. Mm-hmm. And in this case, it boosts economic growth in the short run, as well as, especially because of consumption and investment being lifted. However, it also comes with several macroeconomic costs. For instance, a temporary rise in inflation, as well as a deterioration in fiscal and external balances. And this is shown in the chart through higher government debt to GDP ratios, as well as a deterioration in the current account balance. Overall, every dollar spent on defense tends to generate around $1 of economic activity. However, this effect also varies significantly depending on various factors, such as how the defense spending is financed, its allocation across current versus capital spending, the degree of import leakages, the duration or persistence of the rise in spending, as well as other policy responses.
You mentioned the import leakages there, and of course it is true that, weapons are built in a very few number of countries and then sent, dispersed around the world. And that kind of brings me to a question for Moritz. Your research covers both of these issues, both the macroeconomic impact, but also the defense spending. How do you see this, the economic costs playing out? And I'd really like to hear more about your policy proposal for Europe, where, which has typically been a huge purchaser of U.S. weapons. And I know that there's a lot of movement afoot to try to reclaim that through, to improve European competitiveness in the weapons sector.
Yeah, thank you. I'll be very happy to talk about this and actually end on this. But let me start by congratulating the authors on these excellent chapters that really address the key questions, and they do so in a fantastically clear way and make it very easy and very convincing also to follow the arguments. These two chapters deal with two, I think, probably the two most pressing macroeconomic questions, namely the defense booms and their financing and their real effects, and the other chapter deals with the cost of conflict. Of course, these two are linked, but they're not definitely linked, and I think this echoes a lot of the research we've done at the Kiel Institute on defense economics in the past couple of years, both on sort of the fiscal and multiplier questions, but also on the effects of wars when they break out, especially also the effects on neighboring countries, spillovers to third countries. And also last congratulation, if you will, is that the authors also move into the area which I think right now is the most pressing and the most sort of almost the most interesting, namely how to spend smart on defense, not only from a security point of view, but also, of course, from the economic point of view in terms of how do you maximize, quite literally in this case, bang for buck, and generate the spillovers, the technological spillovers that are important. So I think procurement, contract design, the industrial organization of the defense industry, these are three very important areas that we know far too little about and have to really ramp up research to understand what's happening in the world around us. If we want it or not, you've mentioned this in the introduction. We're clearly, most countries, I hope, are doing this defense ramp up in order to avoid wars, to build the necessary posture in terms of deterrence, so that we don't have to incur these horrible human, but then also economic and social costs of war. So, there's a linkage between the two, and I just want to stress that. There is also a linkage in the sense that if you think about defense spending booms as a way to deter and to avoid wars, because your strength allows you to deter a potential aggressor, then you can think of them as an insurance against the very high cost of wars being fought, the costs that are analyzed in that chapter. So let me come to Europe and our policy proposal, which I've worked jointly on with Elaine Ray and Philip Hildebrand, which brings, I think, quite nicely ties these points together. Even you don't have to agree, or you can agree and disagree, obviously, but it makes the point that it is economically sensible to do what we've just heard, to go to finance defense ramp-ups in the short run with additional debt, with deficits, for the very simple reason that you don't want to save for a long time to build up the deterrence. You want to deter quickly, and you want to have that insurance that's offered by having a strong defense sector. You want to have it very quickly. At least that's the European perspective, which I probably feel most comfortable talking about. So from a European perspective, it makes a lot of sense in this different environment to do it quickly, and to do it quickly, you don't want to start safe, or you don't want to get into very complicated trade-offs between, as it's often called, between guns and butter, because if you need to make room for defense spending in your budget, one option is to cut elsewhere, and I think in the medium term there won't be a way around this. We have to finance this core function of the state to provide security from regular tax revenue, but in the short run, it makes a lot of sense economically to front load the expenditure, to front load the security and investments, and use and smooth the shock through borrowing, and that's what Germany is clearly doing. That some European countries are doing, but not all European countries are in a position to have the fiscal space to do that. So from a European perspective, I think it makes a lot of sense to think about joint borrowing, and so to incur joint liabilities for defense, but do so to acquire joint assets on the other side. So use this really as a way to further and deepen European defense cooperation and integration. And that is particularly important in Europe because we've mentioned procurement and the organization of the defense market. You're right that Europe is a big buyer of American defense equipment. Obviously, that through the import channel that lowers the multiplier. So not only from an economic point of view, that is maybe not the most desired option. Also from a technological innovation and spillover point of view, think about dual use. You want to do things at home. So from that side, there is a European imperative. But more importantly, if you want to build up that deterrence very quickly, you have to borrow. And if not all member states have the same fiscal space, it makes a lot of sense to do this together. Use the money to develop joint next generation defense assets, which Europe needs. I think we see this everywhere, that there's a big shift in the economics of defense. If you think about the cost of mass-produced autonomous systems versus traditional defense procurement, but also to break up what is a very inefficient, you may say even grotesquely inefficient European defense organization that comes from the fragmentation of 27 European forces and 27 different procurement agencies and military structures.
Yeah, well, it's a pretty Herculean task that you're proposing there, and that is ahead for Europe, because getting to agreement and getting cooperation to work in reality is a little bit more challenging than it might look on paper, right? So it's a big deal, but there's also a lot of money at stake. So hopefully the motivations will be greater, right?
I think so. So the feedback we got was quite interesting. if I may say so, we got feedback from typical German position is be very skeptical with respect to joint liabilities in Europe. So very skeptical of Eurobonds and common financing, and that's we know that position. But there was also skepticism, this part more on the French side, to have joint assets. So one side is opposed to joint liabilities, the other is opposed to joint assets. Maybe our proposal, which basically is that Europe, France, Germany, and the other European countries should team up and develop next generation defense together, because it's been proved very difficult to do sort of the legacy systems to do that together, but at least for the next generation, for the space capabilities, for the communications and all of this, the autonomous systems, the AI, the military cloud, Europe should not replicate the mistakes of the past. So our proposal met with equal resistance. Some countries don't like joint liabilities, others don't like joint assets. For me, that's a sign that we're hitting in the right spot.
That's right. So Andressa, what are the key trade-offs that policymakers should take into consideration with regard to increased weapons spending, and how can countries protect those most vulnerable from this guns versus butter dilemma, when they need money and when they are under pressure to increase funding for wars or deterrence?
Thank you, Andrea, for this question. So let me take the chance to dig a little bit deeper into the trade-offs that arise when ramping up defense spending and what this implies for policymakers. So first, defense buildups imply a clear trade-off between growth and inflation, and this calls for a close coordination with monetary policy in order to temper the inflationary pressures. If central banks react to higher inflation by raising policy rates, for instance, then this would temper the demand effect. If, on the other hand, they do not react and allow for the fiscal expansion, they accommodate the fiscal expansion, well, then this would lead to a larger demand effect and could potentially raise inflation. Second, how governments choose to finance the higher defense spending also matters and is critical. If, for instance, deficit financing can lead to a larger output gains in the short run, but over time, higher budget deficits and higher debt can also crowd out private investment or also narrow fiscal space, reducing the space that policymakers have in order to respond to shocks, as well as raise fiscal vulnerabilities. On the other hand, if the financing is mostly coming from either lowering other spending or raising revenues, as should be done when the defense spending increase is more permanent, then this would temper the fiscal vulnerabilities, would prevent them from building up, but on the other hand, entail other costs. For instance, raising tax revenues would dampen the demand effect again, or lowering spending, such as on social spending or other public priorities, could also have long-run adverse effects, for instance, on social or distributional outcomes. And third, another important factor is that defense spending composition also matters. So a larger allocation, for instance, towards current spending, such as military personnel, or also operating expenses, could lead to a larger short-term boost, but also with the risk of overheating the economy in the short run, whereas a larger allocation that goes towards investment, as has been done historically in the US and recently also in Poland, this could actually crowd in private investment and also lead to a long-run increase in productivity. However, of course, raising defense investment could also imply a crowding out effect on other productive public investment. And to the extent that a large share of military equipment tends to be imported from abroad, as is the case in many countries, then this could also dampen the demand effect and lead to an even larger worsening in the current account balance. And finally, just to wrap up, our chapter also speaks to various policies that can be put in place in order to mitigate these trade-offs. For instance, as Moritz just mentioned, a coordinated program for defense spending and financing could lead to a larger productivity of defense investment. It could do so in several ways, by achieving economies of scale, or by raising innovation and knowledge spillovers within a larger integrated market. It could also reduce the import content of defense spending and lower borrowing costs associated with the financing this spending. And our simulations actually show that such a scenario would lead to a larger aggregate output boost, a smaller increase in government debt, but with a risk of slightly higher inflation pressures.
So what you're saying to policymakers is be very careful how you structure this. Don't think about the consequences. And I think you're saying to the central bankers, don't get too excited about shorter increases in inflation. That's part of the bargain, right? Yeah.
Indeed, like the way that defense spending is implemented, the way that it's financed, the composition, and the other policies that are put in place, for instance, the monetary policy, all of these are very important to determining the macroeconomic impacts and trade-offs that this implies.
Mm-hmm. Moritz, I just want to come back to you for a quick second, because you were talking about how these decisions are made. The thing is that when wars start, these decisions have to be made very quickly. There's not an awful lot of time for the thinking and the coordination that you're able to do with hindsight. So do you think that European, and Europe is always a particular challenge because the European Union is a large amalgam of many different countries with different priorities. Is it even possible for policymakers to give this thought and to do this coordination that you're recommending?
Look, it is a challenge, and it's a particular challenge, as you say, in a construction like the European Union that has a lot of voices and a lot of decision makers at the table. Europe will have to find ways. I mean, there is right now obviously a defense setup that allows for more coordinated action in the pure defense field. But I think the challenge now, and again, happy to underline what's been said, is to think about the industrial underpinnings of that and the capacity expansion. To increase production capacity in the defense industry, I think is a particular challenge. We've talked about the economies of scale. Europe is lacking those. And if you look at some of the sort of the key statistics for how the European defense industry is set up and how production capacities are set up, those trade-offs that we've just heard about between the sort of the growth impact and the inflation impact become very acute. Obviously, you would love to have in a situation like this, you would love to have spare capacity, so additional additional money going into the sector does not lead to big price pressures. Absent those, you want to quickly increase production, you want more investment, you want to increase production capacity, and not just end up with higher prices. And let me just give you one example that really underlines the challenges that particularly Europe is facing on the fragmentation of the defense industry. I mean, the numbers, one of the statistics that people like to look at is the United States have one main battle tank. So, one tank that is used in U.S. armed forces. In Europe, the armed forces of the different European nations operate 14 different battle tanks. The U.S. has 4 types of submarines. Europe has 16 types of submarines, etc., etc. You could go through all the different systems, and you would find that fragmentation. And fragmentation means we don't realize the economies of scale. We arguably also don't get all the sort of the maximum effect of joint spending on research and development. And so I think here the challenges for Europe are particularly large, but challenges are great because economists can really help. And it's a field that I must say that us as economists have not studied very closely for a long time. Defense economics is not, the field that we spend particularly a lot of resources on. But it is becoming extremely important because in no area are governments putting much additional money into the economy right now. So we need to understand it much better than we do. And just to give you one example, I think economists can be extremely useful is the whole area of market design, contract design. Because you're talking typically about a situation where there's only one buyer. It's not a big market with different players on the demand side, and on the supply side, on the producer side, it's typically an oligopolistic situation in many industries. So we have a very different setup from the setup that we usually face in sort of standard economic and market design problems. And one idea we've built, for example, putting out recently, you're emphasizing is the idea of planning for capacity and contracting, procuring capacity instead of just procuring defense equipment, because what's needed is an expansion of the capacity that economies have to produce these goods. And we've learned a lot of things, for example, in the pandemic, how we can quickly, through contract design, through smart mechanisms, increase the efficiency of that spend.
Terrific. Hippolyte, speaking of advice and capacity development, the IMF provides advice for countries recovering from conflict. What policies should countries pursue post-conflict to ensure a sustained and resilient recovery and to minimize the scarring that you've spoken about? I mean, what can they do even as a war is unwinding or as it's playing itself out to ensure that the future is brighter?
Thank you, Andrea. So let me restart what Maurice just said. I mean, war are costly, both on the human and economic side, and avoiding them, of course, are first order. Now, in the chapter, we look at how can economies can rebuild better after war ends, and using a range of analytical tools, including historical empirical analysis, case studies from successful recovery countries, and also a model framework that kind of allows us to assess the implication of different post-conflict recovery policy scenarios. And the good news for policymakers is that policies can play a decisive role in shaping post-conflict recovery outcomes. And let me highlight quickly 3 key findings from the chapter. The first one is that decisive debt restructuring, early macroeconomic stabilization, and international support, as you mentioned, through aid and capacity development, play a key role in the restoring confidence, but also fostering the recovery. For instance, debt restructurings are typically key to help in some way restore fiscal sustainability, and that can kind of pave the way for macroeconomic stabilizations, given that in many post-conflict settings, for instance, countries end up with high debts. So now, how do countries achieve macroeconomic stabilization in practice? There we find that in most cases, stabilization is achieved through a combination of rapid restoration of the supply side of the economy once the war has ended, some kind of credible nominal anchor on the monetary policy sides, and also some fiscal adjustment, often backed by IMF support program. The second key finding is that rebuilding effort need to be complemented by other domestic reforms, including, for instance, to rebuild institutions and state capacity, but also mitigate some persistent human capital losses from conflicts. Just to be more concrete here, some measures that post-conflict recovery cases have done include, for instance, strengthening anti-corruption frameworks, fostering a peace dividend, that is creating fiscal space for social spending and other non-military spending, but also promoting policies for refugees return and integration. And this can include, for instance, access to housing or even basic services. A third key finding from the chapter is that faster recovery requires a comprehensive and also well-coordinated policy package, as shown on the chart here. So the model simulation shows that individual policies alone cannot fully offset the output losses from conflicts, which suggests that a comprehensive policy package outperforms a piecemeal one. Now, in terms of policy sequencing, policies that kind of rebuild confidence, but also and restore destroyed capital, deliver a faster recovery. And this basically reflects the role of complementarities across policies, but also economic agents' expectations about the future. For instance, policies that focus on rebuilding confidence and also rebuilding the capital can in some way improve economic agent, household and firms, for instance, expectations about the future, reduce domestic borrowing constraints, and also attract more capital inflows. And that can contribute to raising wages and economic opportunities, but also give more incentive for refugees to return home. And this mechanism can kind of create a virtuous cycle for a stronger recovery post-conflicts.
I'm afraid that's all we have time for. What a fascinating discussion, and I think we could continue delving into these issues for hours, really. I mean, just all the implications are so great. So we've really heard here, some unique research that was comparing and looking at deeply into the data from 164 countries over a very, very long period of time. It provides a lot of insights, and as you said, Moritz, economists can really help shape policy outcomes. I'm sure we all need your guidance at this moment in our world, where we have active conflicts in so many places, and of course the very large Middle East conflict now unfolding kind of daily. But so thank you very much, Moritz, Andressa, and Hippolyte, for joining us, and we look forward to seeing more detail when people can read the chapters from the WIO, and then the full WIO coming up next week. Stay tuned for lots more discussions coming up in the following weeks at the spring meetings as well. Thank you so much.